Have you ever noticed how changes in the economy can sometimes feel like a puzzle, especially when it comes to something as fundamental as prices? It is a question that has intrigued economists and individuals alike for centuries. What really drives the cost of goods and services we buy every day? While it is a powerful force, an increased money supply does not always immediately or proportionally raise prices in every single scenario. However, there is a very strong and fundamental theoretical link, primarily explained by the quantity theory of money. At its core, the quantity theory of money provides a straightforward framework. It is often summarized by the equation MV equals PY here. M stands for the money supply, or the total amount of money circulating in an economy. V represents the velocity of money, which measures how many times the average unit of money is spent on new goods and services in a given period. P is the aggregate price level, what we commonly refer to as prices. And Y denotes the real output of goods and services, essentially the economy's real production. The crucial insight comes from the theory's assumptions. If we assume that both the velocity of money and the real output of the economy are relatively stable or constant in the short to medium run, then any increase in the money supply, M, must be reflected in a proportional increase in the price level, P. Think of it this way. If you have more money chasing the same amount of goods and services, the price of those goods and services will naturally go up. This is the bedrock principle, connecting money supply and inflation. However, the real world is dynamic. The velocity of money is not always perfectly stable. For instance, during times of economic uncertainty, people might hoard money, causing velocity to fall, which can offset some of the inflationary pressure from an increased money supply. Conversely, during booming periods, velocity might increase. Also, real output, Y, can change. If an economy has significant spare capacity, an increase in the money supply might first lead to an increase in production rather than an immediate jump in prices. This is why the word always can be tricky. The timing and magnitude of price increases can vary. Understanding these dynamics is vital for central banks as they manage monetary policy. While they do not solely focus on the money supply in isolation, it remains a critical indicator. Monitoring how money supply grows helps policymakers anticipate potential inflationary pressures and guides their decisions on interest rates and other tools. It is a key piece of the puzzle, even if not the only piece. A concept closely related to this is monetary neutrality, which suggests that in the long run, changes in the money supply only affect nominal variables like prices and wages, but not real variables like real gross domestic product or employment. It is a powerful idea that highlights money's role as a medium of exchange rather than a direct driver of real economic growth in the long term. Economist Milton Friedman famously highlighted that the effects of monetary policy often occur with long and variable lags, meaning the full impact on prices might not be felt for many months or even years. So, while a direct and often proportional relationship exists between money supply and the price level, especially in the long run and under certain assumptions, the short-term reality can be more complex. Factors like changes in the velocity of money, the economy's capacity, and the time it takes for monetary policy to take effect can influence the exact outcome. By grasping these underlying mechanisms, you gain a deeper understanding of one of the fundamental drivers of inflation and how economic policies attempt to manage it.